We've seen a lot of volatility in the tech market over the last 6 months or so. How has that impacted your investment strategy?
Well, it's created more opportunities, Emily. You know, when we started the fund, roughly 22% of equity assets in the United States were in active vehicles, in passive vehicles. And today that number is north of 38%. And so as more and more dollars have flown out of active management and into passive management, by definition, the market has become less efficient.
So humans less involved, machines more involved.
Machines more involved. And machines do a great job at pricing securities based on trailing metrics. So trailing PE, trailing free cash flow, price momentum, factor momentum. They do a very poor job of predicting the future. So in a vertical like tech, where there's a lot of secular change, machines really struggle on predicting, is Uber going to disintermediate Hertz and Avis? Or how is Airbnb going to affect Hilton, IPG, and Starwood? Or is SpaceX going to affect Lockheed Martin's satellite launch business? Those are questions that require active fundamental research. And so as more and more dollars flow into passive vehicles, the market, by definition, is becoming less efficiently priced for the future.
It's interesting you mentioned Uber because SoftBank's making this big investment in Cruise, while they also have a big investment in Uber, which also has a struggling self-driving car business. Why?
Well, look, at the end of the day, SoftBank wants to be involved in as many facets of that value chain as possible. Over a long period of time, we think that all these players consolidate. We have
How so? Who becomes part of what?
Well, it's a great question. I mean, you've already seen consolidation overseas. So Grab and Uber have joined forces. Didi and Uber have joined forces in China, and in Russia, Uber and Yandex have joined forces as well. And so we think there will be continued consolidation across the value chain. It's unclear whether auto part suppliers end up consolidating with autonomous driving purveyors as well. But at the end of the day, we are moving from, obviously, people ownership to vehicle as a service. And so these vehicle fleets will be managed by one large entity, likely an Uber SoftBank conglomerate. And service, parts, repair, et cetera, will all be done by that large.
Now, right now, 50% of your portfolio is focused on Asia.
That's correct.
Is that right?
Yeah.
Why?
You know, Asia is one of the most attractive areas to invest in for a number of reasons. One, it's highly inefficient. There are less institutional managers over there doing active fundamental research. But it's also the area over the next 20, 30 years where we're likely to see the most growth. We've seen multiple multi-billion-dollar exits now coming out of China in the internet space. And we expect in Japan, Korea, Southeast Asia, those trends will play out as well. If you think about the internet's evolution in Asia relative to the U.S., we're about 5 to 10 years behind, just in terms of smartphone penetration, in terms of software penetration in some of these major markets. And so, you know, the next big exits into the public market are more likely to come from China, Korea, Japan, Southeast Asia.
And you're in some Asian competitors to U.S. companies, like payments competitors Stripe and Square.
Yes. One of our favorite ideas in Japan is a company called GMO Payment. And it's sort of a hybrid Square Stripe player, and it dominates the payment landscape in Japan. They don't actually compete in North America, but they've taken various elements of the business models of their North American competitors, and they've applied that to a Japanese market, which is really hard to penetrate for U.S. players.
You've also got a huge position in Wayfair, which is your biggest position, which has been quite controversial since Wayfair hasn't been doing so well.
Well, it wasn't doing so well from a stock market perspective earlier this year, but the stock is now close to a 52-week high. Wayfair is really interesting. If we step back and we think about the categories that are penetrated online, home goods is the least penetrated category online. About 12% of home goods is on the internet today versus apparel, which is 28%, consumer electronics, north of 35%. Most folks think that Amazon is going to dominate every category on the internet. And we have seen certain consumer discretionary categories. They've been very challenging for Amazon to dominate. One of them has been furniture. So Wayfair is growing about 46% year over year. The offline market's growing about 1.5%. And so Wayfair is growing 30x the offline market. It's growing nearly 3x the online market. One of the reasons they're growing so much faster than Amazon is curation. So when you shop for furniture, when a consumer shops for furniture, the brand doesn't matter. So Amazon's great if you know what you want. So if you know I need that 5-ounce bottle of Clorox to refill from last week, Amazon's the best place to find it, right, in terms of price and speed of delivery. But if you don't know what you want, Amazon's a really tough place to shop. And it turns out in the home goods category, when designing a room, people like to move things around. They like to do 3D visualization. They like to swap out color palettes. Downstream delivery and fulfillment is really important. So Amazon primarily has a drop ship model. Wayfair has built out their own delivery network. And so if you can imagine trying to receive a large couch to your walk-up house or apartment in a major city, it's important to know when that's actually going to arrive. And so a lot of these things Wayfair solved in a big way, and Amazon's really struggled in this category.
Does that make you less optimistic about Amazon in general?
No, we're still very large shareholders in Amazon. We think Amazon has a massive opportunity. If you think about the penetration of consumer goods online, it's still very early. So Amazon's been around 20 years. Only about 10% of the world's goods are sold online. We expect that to go to 20 to 30% over time, and we think Amazon has a tremendous competitive advantage in those verticals.
What about some of the other big tech names? Facebook, obviously, top of mind, given all of the controversy over the last few weeks.
Yeah, look, it's the sort of irony about government regulation is that it makes the largest players even stronger. Because smaller players financially cannot compete when it comes to making sure that they're up to regulatory standards. And so we've seen just over the last few weeks reports out of Europe that both Facebook and Google have been capturing a disproportionate amount of share of ad dollars as a result of some of the new regulatory things put in place by the European regime. So look, we're bulls on Facebook still. It's now north of a $500 billion market cap. We invested at IPO and 5x'd our money from the IPO. So it's not as big as a position as it was in the past, but we still like the opportunity from here going forward.
Does slowing growth in the Facebook proper service concern you, though? I mean, obviously they own WhatsApp, they own Instagram, they've got Facebook Messenger, but Facebook itself, you're not seeing the same growth that we've seen over the last 14 years.
That's true. You're not seeing it from a user perspective. You still are seeing, though, incredible growth from an ad perspective. So Facebook in the United States is still growing its ad revenue north of 40% year over year. And for that, as an investor, we're paying less than 15 times EBITDA. So we always hear pundits, right, arguing that tech's in a 9-year bull run, tech's very expensive, and that there's very little upside from here. And we sit here and say tech's one of the cheapest sectors in the market. If you think about tech relative to, say, CPG, right, you have these consumer product companies selling you a can of sodium for $6, trading at 25 times earnings, not growing, with declining margins.
So give me one controversial position, one controversial stock you're not excited about.
One controversial stock we're not excited about. Grubhub. And we've wrongly not been involved in Grubhub since IPO. We invested in all the delivery players overseas, so we're large shareholders in Delivery Hero as well as Just Eat. We miss Grubhub. Frankly, we thought in the United States that it would be very difficult, given the spread out suburban communities, for Grubhub to be successful. They've done a great job from an execution perspective. I'm still not that excited about Grubhub long term. You look at Uber Eats. We own Uber. It's about Uber Eats is doing about a $6 billion run right now in terms of food delivery. They've got all this capital and scale, and we expect over a long period of time that Uber is going to run over Grub.